Hey there, folks. Welcome back to Edge-Forex, where we take the financial world's hottest trends, tear them apart, and put them back together in a way that actually makes sense. Today's episode, we're diving into the dark side of something everyone seems to think is innocent: passive investing. Yeah, you heard that right. You've probably seen the slogan, "Set it and forget it," pop up everywhere promising you low fees, minimal effort, and supposedly safe returns. But let me ask you this: if everyone's jumping into passive investing, what happens to market stability? Could this so-called easy button be the ticking time bomb no one wants to talk about? Let's break it down. All right, first things first. Passive investing, it's like the fast food of finance. Easy, accessible, and for most people, gets the job done without too much thought. With ETFs and index funds, you can just throw your money at the S&P 500 and call it a day. But here's the thing. Passive investing has gone from a fringe idea to mainstream addiction. Just a few stats to chew on. Since the 2008 financial crisis, passive investing has absolutely exploded. As of today, passive strategies make up over 50% of US stock funds. That's trillions of dollars, just flowing into indexes without a second thought. Sounds efficient, right? Well, maybe. But here's the problem. When everyone's setting and forgetting, nobody's doing the real work of price discovery anymore. We've essentially turned Wall Street into a self-driving car and assumed it'll know how to steer in a storm, but what happens when the road gets bumpy? Let's get one thing straight. People think passive investing is safe. Why? Because you're just buying a piece of the whole market. There's this comfort in numbers, in not picking individual stocks. But what happens when the entire market moves the same way because of these index-driven trades? Think of it like a huge herd of animals, all moving in one direction, look strong and unstoppable, until they all head toward the cliff. You see, when a crisis hits, whether it's a global pandemic, an economic collapse, or a debt crisis, that illusion of stability evaporates fast. And what do people do? They panic, they sell. The passive funds have to sell too, and we get this waterfall effect where everyone's trying to exit the same door. Passive investing may reduce volatility on the way up, but it sure as hell amplifies it on the way down. Let's talk about the elephant in the room: price discovery. This is a fancy term for the market's way of figuring out what things are really worth. It's what keeps stocks in check, gives us corrections, and reflects the actual health of a company. When you're passively investing, you're not asking, is this stock overvalued, or is this company really worth my money? You're just buying into the whole index without a second thought. And who does this help? Well, big corporations, for one. It lets them fly under the radar, get free access to capital just because they're in the index, and get this, they don't even have to prove their worth. This creates an incentive for mediocrity. Imagine a world where companies don't even need to work hard or innovate because they know passive funds will keep pouring in cash as long as they're in the index. That's a recipe for stagnation, folks. And what about accountability? Passive investors aren't voting at shareholder meetings. They're not holding CEOs' feet to the fire. They're simply letting their money ride on autopilot without any real engagement in the businesses they supposedly own. So who's left to keep the market honest? Now let's take this to its logical conclusion. When passive investing dominates the market, it's no longer passive. It's the invisible hand guiding everything, from corporate decisions to investor returns. But here's the kicker. It's not based on value, growth, or innovation. It's based on, well, whatever makes it into an index. In the worst-case scenario, passive investing doesn't just follow the market, it becomes the market. We get bubbles because investors are throwing money at the top holdings in every index, driving prices higher and higher regardless of actual value, and like any bubble, it's just a matter of time before it pops. So, what's the solution? Do we ditch passive investing altogether? Probably not. It's here to stay, and for a lot of people, it's a decent way to dip into the markets without needing a PhD in finance. But here's what we do need to consider: balance. Passive investing should be part of a portfolio, not the whole thing. Diversification is key, and that includes having active management, alternatives like gold, and yes, some good old cash on hand, accountability. passive investors should educate themselves on what they're really investing in. Just because it's low cost and easy doesn't mean it's always wise. Innovation pressure. We need investors willing to look for the next Tesla, the next Amazon, the next real innovation, instead of just dumping cash into the current top dogs. In other words, the more passive we all get, the more active some investors need to be to keep the market healthy. All right, folks, that's all for today's episode. Remember, the next time someone tells you to set it and forget it, just remember, autopilot might work for your Roomba, but it's a risky game in the stock market. Thanks for tuning in to Edge-Forex. Hit that subscribe button, share this episode if it got you thinking, and let's keep questioning the trends that everyone else takes for granted. Until next time, stay sharp, stay skeptical, and keep your eyes on the real value.